Hello once again, guys. Welcome back to the channel. I hope you're having an awesome day so far. So in this video today, we're going to be talking about the best recession-proof stocks. Now, a lot of people out there are talking about the stock market and whether or not we're going to be going into another correction or a stock market crash going into 2022. So I wanted to go ahead and put together a list of stocks for those out there who are looking to, maybe get a list of some safer investments that have panned out relatively well in the recent recessions or stock market crashes that we have had. Also, guys, I went ahead and set up sort of a different, angle here with this camera. I was getting all kinds of comments about my beard, and I think maybe it was a little bit too close up. So now we've got a little bit more distance here. If you guys like this camera setup better, let me know in the comments or go ahead and drop me a like. I'm down here at my Florida property, still kind of trying to work out the kinks with this recording setup. So any feedback like that is greatly appreciated. But let's jump right into the presentation now and talk about the best recession-proof stocks. First of all, guys, I have a real quick disclaimer here. I am not a financial advisor. This is not any sort of financial advice, and you should always do your own due diligence above and beyond this video before making any investment decisions. Also, I have been getting a ton of spam and scam comments down below, so if you are communicating with myself, make sure there is a white check next to my name. Otherwise, you are most likely talking to a scammer who is looking to take your money. That out of the way, guys, let's jump right in here. And we're going to first talk about the performance of the S&P 500 during the two most recent recessions or crashes. Now, the COVID recession that we had was one of the fastest, I believe the fastest in history in terms of the recovery. But rather than just throwing out random names of stocks and saying, hey, these are good ideas during a recession, we're going to be looking at the data and comparing the returns of those investments during the last two recessions to the S&P 500. Because at the end of the day, the goal that you should have during a market downturn with a recession-proof stock is that you want that stock to outperform the overall market or the S&P 500. So probably during a recession, almost everything is going to go down somewhat for a period of time, but it's a question of whether or not the stocks that you're holding or the funds that you're holding go down equal to the S&P 500, more than the S&P 500, or less than the S&P 500. So obviously, for a recession-proof stock, what you're actually looking for is more of that downside protection during a market correction, which could lead to a market crash. So it's not so much about the upside that these investments have. And during times of, good bull markets, actually, there's times when these investments underperform the market. It's about how these investments respond when the floor gets yanked out from under the stock market. That is what we care more about, not so much the performance of these stocks in a multi-year bull market, which really had just a very short blip there during that COVID recession. But that being said, guys, the data we're going to go off of here is looking at the correction from the 2008 recession. That was a 40.5% drop in the S&P 500, and then during the COVID recession, it was a drop of around 25.2%, which is, outlined in that block right there on the chart. Now, since February of 2020, there's been a massive rally with the S&P 500 up over 34%, and this, along with inflation worries and eventual Fed tapering, is what a lot of people are then saying, hey, maybe we're going to be due for another correction or a crash in the future. That is why this very timely video is coming at you here, talking about those stocks. And also, it's important to think about how long these recessions last, because the most recent one that we had was really not a real market recession. And even somebody like myself has truly never really been an adult or been conscious really of the stock market during a real recession. I'm 26 years old. A lot of people think I'm like 40 now because I have this beard. But no, I'm still 26. I'll say that much. So during the 2008 recession, I was about 13 years old. So of course I remember the news and I remember my dad being stressed out, but I wasn't an active participant in the market. During that recession, it took basically a year and a half for that recession to finish out and then for us to come out of it. Whereas during the COVID recession, it literally only took 2 months. So just understand that that's not really what normally happens. The most recent recession that we had was not your typical recession. So anyways, guys, starting off with number one on the list here is none other than Walmart, trading under the symbol WMT. And if you take a look at the performance of this stock during that COVID recession, I mean, we really had barely any blip here whatsoever with Walmart stock. During the 2008 recession, when we said the markets dropped around 40%, this actually gained 1.1%, which is way outpacing the S&P 500. And during the COVID recession, they actually gained 5.6%. Now, that being said, since February, they're only up 17.2, whereas the overall S&P 500, as we had said, was up somewhere around 35. So there was a lot better downside protection. In fact, you actually made money as a Walmart shareholder during the last two recessions, but it is important to note that it did underperform the S&P 500 coming out of that COVID recession. So some quick information here on Walmart. They are founded in 1962, market cap of $413 billion. They are a dividend aristocrat. They've been increasing dividends every single year for 48 years. And they currently have a dividend yield at 1.48%. Now, why is Walmart a good recession-proof stock? Well, it comes down to the fact that Walmart's unique identifier is known as EDLP, or everyday low prices. When discretionary spending is down, Walmart revenues go up. Quarter one revenue 2020 was up 8.6% versus that same quarter in 2019. And what it sort of comes down to, guys, is this. Some of us have to shop at Walmart because we need to make sure we're getting the most out of every dollar that we have. I mean, let's be honest, nobody goes to Walmart for the shopping experience. It's terrible, but we do it because it's cheap. And at times when, money is tight or we're uncertain about the future, you're going to see a lot more people, going to a Walmart than you would maybe going to a Whole Foods, especially if you're tight on money. So it's kind of a necessary evil in a lot of ways that, a lot of people have to save money and shop at Walmart, or maybe you're a savvy shopper and you don't really care about, the stores being crowded or long checkout lines, and maybe you do online ordering or something. I'm not sure, but Walmart has done well in the last two recessions. That is why they are number one on the list here for recession-resistant or recession-proof stocks. Coming in at number two here is a name that I don't think we've ever really talked about on this channel. And in terms of comparing this company to the size of Walmart, this is less than 1/10 of the size of Walmart. So this is a mid-cap company, not a large or a mega cap, but still a pretty large company that's been around all the way since 1928. That is General Mills, trading under the symbol GIS, headquartered in Minnesota with a current dividend yield of 3.2%. Again, we want to compare this as to how it performed during the 2008 recession and then the COVID recession. During the 2008 recession, we saw that the stock actually went up 2.3%. And during the COVID recession, this stock went up 9.3%. However, again, as was to be expected with these stocks, it has underperformed the S&P 500 coming out of that recession. Again, though, you can't really have the goal of outperforming the market and having downside protection. It's kind of like wanting to have your cake and eat it too. At a certain point, you do have to pick one or the other. Am I looking for, beating the S&P 500 in a bull market, or am I looking for downside protection in a bear? Very rarely are you going to find a stock that's going to offer you both. Now, why is General Mills a good recession pick? During recessionary times, people look towards purchasing more groceries versus eating out. It's a very simple concept. When you have extra money, you spend money on entertainment, on drinking, you go out on date nights and stuff like that. And then when you have less money coming in, you're going to spend more money on, your groceries. And probably the more common example these days is Grubhub or meal delivery versus, groceries. A lot of people, can't necessarily spend all the money they were ordering food to their door. So instead they might be doing a shipped order and a grocery order and ordering a bunch of grocery products. General Mills makes a lot of cereals and grains and crackers and things like that. So that is why they do well during a recession. And we can see this very clearly because revenue for them in quarter one of 2020 was up 9% versus the same quarter for the previous year. The only difference was in quarter one, people weren't going to restaurants, people were buying more groceries. So that is why they are number 2 on the list. Number 3 is a stock I've never owned myself, but I have owned Lowe's in the past and did really well. Honestly, guys, Home Depot and Lowe's were 2 of the biggest winners coming out of the COVID recession. Really unbelievable performance here. Now, the downside protection wasn't there as much with these stocks initially. It didn't fall as much as the overall S&P 500, but it did have a negative return during that period. Quick information here on Home Depot. This is another mega cap or large cap company here sitting at $428 billion, founded in 1978, headquartered in Georgia, with a current dividend yield of 1.61%. And during the 2008 recession, this stock had a positive return of 2.4%. During the COVID recession, it did drop 17.7, but what I want to call your attention to is this performance since February of 2020. As we said, the S&P 500 returned somewhere over 30%. This is more than double the return of the S&P 500 for that period of time coming out of the COVID recession. So the performance was really stellar here. This might have been a bit unique because of the great reshuffling or the great migration, whatever you want to call it, where everybody, and including myself, a lot of people were relocating and then getting involved in home improvement projects because, obviously hardware stores were one of the only essential businesses. But I think this is a solid pick during a recession, honestly, going forward. And there's many reasons behind this. One of the main reasons is because during a recession, people are less likely to contract work out. And the other thing is, too, you may find that people are staying in their older homes for longer versus selling their house and, buying a new apartment or something like that. People tend to stay where they're at during a time of uncertainty. And if they're in an older home, well, as a homeowner, or if you don't know, there are going to be constant repairs and random stuff you have to fix. What this is saying here is you're more likely to fix those things yourself and be more of a DIY handyman. And so that's why Home Depot just tends to do well, because whether it's buying, things for your projects that are, more discretionary where you have a choice around spending it, or it's, hey, I have to fix the siding on my house that's falling off, they tend to benefit from both categories. So they are number 3 here on the list. And we saw that in quarter one of 2020 when, the global markets were collapsing and things were just not looking great for a lot of companies. They actually grew revenue. It was up 7% versus the same period in the previous year. So number 4 on the list here is a very boring company, probably one that many of us just have not heard of. And this company went public in April of 2008, so we can't compare it for the period of the 2008 recession. During the COVID recession, however, when global markets sold off massively, this only went down, 2.2%, which is pretty incredible. And since February of 2020, it's up around 26.8%. So it has slightly underperformed, the rally of the S&P 500 out of that recession. So this is the American Water Works Company, Inc. I've never owned the stock personally, but it does definitely deserve to be here on this list, trading under the symbol AWK. Market cap of $30.9 billion, making this a mid-cap stock, but this is a old, time-tested investment founded back in 1886, headquartered in New Jersey, with a current dividend yield of 1.41%. So why is this a good pick during a recession or a time of uncertainty? Well, demand for utilities, such as water, for example, is relatively inelastic. So it doesn't really go up and down and change. And so what we saw here too is, and this is probably a result of the stay at home trend with people being at home, you're going to cook more at home, you're going to be running your dishwasher more, or just consuming more drinking water at your house versus the office. Revenues were actually up 3.8% throughout COVID in Q1 of 2020. So water is an essential resource similar to electricity. And these are things that no matter what, we're just going to pay these bills because we need to have water and we need to have electricity for civilized life. Now, typically speaking, during a bull market, it doesn't mean you're necessarily going to be consuming triple the water. You typically just use the same amount of water, and just continue about your daily life without thinking about it. And as far as cutting back spending, you don't really hear a lot of people talking about cutting back on their water usage or consumption. Maybe during a drought, maybe if you're in really dire straits, you put a timer in your shower and you take a 5-minute shower, but it's just not very common. Most people don't think about it. They don't really try to curb their water consumption during a recession. That's usually more for environmental reasons. So that's why this is another solid pick on the list here, a boring but stable investment during a time of uncertainty. Coming in at number 5 on the list here is a grocery store giant known as Kroger. And this is a company that's another mid-cap stock here with a market cap of $32.5 billion. Very old company here, founded back in 1883, with a current dividend yield of 1.92%. So what was the performance of this stock like in the last 2 recessions? Well, during the 08 recession, it did drop 20.5%, which was less than the overall S&P 500. However, during the most recent COVID recession, this stock was a tremendous winner, and it was up 14.2%, while the rest of the S&P 500 dipped around 25. And then even coming out of this COVID recession, performance has been stellar as well. Since February of 2020, up about 56%. So overall, Kroger has been a really solid pick in the last 2 years. It did pretty decent in the 08 recession in terms of outperforming the S&P 500, and it should definitely be on your watch list or your short list for recession-proof stocks. Now, why is this a solid choice here? Though it's not as cheap as Walmart, demand for groceries, again, increases during a recession for the same reasons as Walmart. Again, Walmart's going to have probably more demand because it's the cheapest option out there, but Kroger, again, is going to benefit from people doing less dining out, people doing less takeout, and just cooking more meals at home. And we saw that in Q1 of 2020, whereas the revenues were up 11.5%. Coming in at number 6 on the list here is a stock that I've just looked at this stock so many times, dating back to even 2017. I've never jumped in, and obviously, guys, at any point in time, really, if you jumped in on Costco, if you held it for the long run, you would have done exceptionally well with this stock here. Costco has a market cap of $232 billion, founded in 1983, headquartered in Washington, and they pay a small nominal dividend here of 0.6%. Now, during the 08 recession, they sold off quite a bit. They dipped almost 35%, but the business model for Costco has largely changed since 2008. They're a much bigger and better company than they were back then. And during the COVID recession, they actually gained 1.4%, and they may also be the top performer coming out of the recession on this list with a return of 68.8% since February of 2020. And if you look at the box here highlighting when that COVID recession was, I mean, there was really no blip at all. You wouldn't even know there was a recession looking at this stock. So why does Costco do well during a recessionary time? Well, even with a membership, buying in bulk can provide significant savings. And also because people are forced to have a membership with Costco in order to shop with them, it sort of makes you a more loyal shopper to Costco overall, because if you're paying for a membership every year or every single month, you're going to want to get the best bang for your buck, which means you're probably going to be a relatively exclusive shopper to Costco for those reasons. We've also seen, their private brand, Kirkland, I believe it's called, has beaten many like name brands in terms of sales. So they've done really well at selling their own branded products as well. So Costco honestly has done exceptional, and it will most likely do well in a future recession as well for those reasons. And revenues were up 7.2% in quarter 3 of 2020. So they also performed well during that recessionary period, or coming out of the COVID recession. Number 7 on the list here, guys, is a company called Waste Management, trading under the symbol WM. Now, I will say this, I would be a little bit hesitant with Waste Management, but I did feel like it should be included on the list because it's another utility stock that tends to have, relatively steady demand for the service. Waste Management is obviously a trash and recycling collection company that I lump in with utilities, these things that you pay no matter what. I mean, when people are cutting costs, I don't really ever hear of anybody saying, hey, I canceled my trash and recycling pickup and I'm going to bury my garbage in the yard instead. Nobody does that. You just pay for these things no matter what. Again, making the demand for waste management relatively inelastic. The company has a current market cap of $68.5 billion, founded in 1968, headquartered in Texas, and a current dividend yield of 1.41%. Revenues were flat all throughout COVID, which makes sense because you're not going to really see an increase in the demand for these services. It just is steady pretty much all the time. So for that reason, it wasn't necessarily the top performer, but it was less of a drop than we saw with the overall market in the 2008 recession and in the COVID recession. And it pretty much nearly kept pace with the S&P 500 since February of 2020, falling slightly under it with an overall return here of 31.7%. So Waste Management is not by any means at the top of my list for, recession-proof or recession-resistant stocks, but I do think it is one that is still worth keeping on your radar, especially if it does have a nice pullback. It could be a decent stock to accumulate shares of during a recessionary time. And then lastly on the list here, guys, we have Dollar Tree, trading under the symbol DLTR. This company has a market cap of $30 billion, 30.6, so it's another mid-cap stock, founded in 1986. This is not a dividend payer, but the performance of this stock has been decent during the last 2 recessions. During the 2008 recession, this stock was a huge winner, and it went up 60.3%. And then during the COVID recession, this stock only went down 6.2%, which is substantially less than the drop that the overall S&P 500 experienced. And then coming out of the COVID recession, this stock had a gain of 56.5%, which is pretty dang incredible. Now, why did they do well during the COVID recession? It's because discount retailers typically see an increase in demand during recessions. Again, it ties back to the same idea we were talking about of people have less money to spend, and so they're looking to get the best bang for their buck. So discount retailers tend to do well in those scenarios. Also, Dollar Tree sells a bunch of groceries and food. So if we're eating out less at restaurants and cooking more meals at home, more people are going to be buying groceries and items, etc. at the Dollar Tree. And we saw this in their revenue figures, which were up 8.2% in quarter 1 of 2020. Now, the last thing I want to cover quick here, guys, is where to actually buy these stocks should you be interested in making an investment in any of these companies. So the number one brokerage that I use is, of course, M1 Finance. And if you guys are looking for a portfolio-based investing platform, M1 Finance is a really solid brokerage to consider. And they offer things like portfolio, dynamic rebalancing, dividend reinvestment, automated contributions, and awesome features like that, which can allow you to pretty much put your wealth on autopilot. 4.6 star rating in the App Store. And they also offer investing, borrowing, which is a low-cost portfolio line of credit. And then they have a debit and credit card as well, which can allow you to earn other cashback rewards and even invest some of that cashback that you earn back into your portfolio. Also, guys, they are still running that deposit or transfer promotion here. So if you deposit or transfer in the amount here on the left, you will get this bonus on the right, paid out on January 31st, 2022. The minimum deposit is $1,000 to get a bonus of $30. But let's say if you wanted to transfer a brokerage account, if you had, for example, a $50K value account that you transferred in, you would get a $500 bonus. So if you guys want to check out M1 Finance, there's going to be an affiliate link down in the description below if you decide that you want to check it out and view their investment options. But anyways, guys, that's going to wrap up this video here. I hope you enjoyed it. If you did, please drop a like and subscribe to be notified of those future updates. And as always, I hope to see you in the next video.